What if I told you that the first truly global financial system didn't begin in London, didn't start in Amsterdam, and wasn't invented by modern banks at all? What if the world's first interconnected system of credit, currency, exchange, insurance, debt, and trust was built more than 1,000 years ago without computers, without central banks, and without modern money? And what if that system quietly shaped how global finance still works today, from trade deficits to debt empires, yet almost no one talks about it? This is the mystery of China's Silk Roads. Most people imagine the Silk Road as a simple trade route, caravans carrying silk, spices, and porcelain across deserts and mountains. But that picture hides the truth. Because the Silk Roads weren't just roads, they were financial networks. And they didn't just move goods, they moved money, credit, risk, information, and power across continents. In fact, the Silk Roads created something the world had never seen before, a global financial system, centuries before modern capitalism. But here's the question that should bother you. If this system was so advanced, so powerful, and so interconnected, why did it eventually break? And what does that collapse have to do with our world today? To answer that, we need to rewind not to Wall Street, but to ancient China. To understand how the Silk Roads became a global financial system, we need to start with a basic truth that history often glosses over. For most of human history, China was the world's economic engine. By the Han Dynasty around 200 BCE, China already had a massive population, advanced agriculture, state-run industries, standardized weights, measures, and currencies. A powerful bureaucracy capable of managing long-distance trade. While Europe was fragmented into small kingdoms, China operated more like a continental superstate. But China faced a problem. It produced goods the world desperately wanted: silk, iron, tea, porcelain, yet it was surrounded by vast distances, hostile terrain, and unstable border regions. Moving goods wasn't just dangerous, it was financially risky. Caravans could be robbed. Currencies varied wildly. Deals made in one city could collapse in another. And carrying large amounts of metal money across deserts was an invitation to disaster. So China did something revolutionary. So just building roads, it built systems of trust. The early Silk Roads began as diplomatic and military routes under the Han Dynasty, linking China to Central Asia. At first, trade was simple barter: silk for horses, grain for precious stones, metal for protection. But barter doesn't scale. As trade expanded across thousands of miles from Chang'an to Samarkand to Baghdad, something had to change, and that change was financial innovation. The first breakthrough: standardized money. China was one of the first civilizations to use standardized coinage at scale. Later, during the Tang and Song dynasties, China introduced something even more radical: paper money. Think about how dangerous this idea was. Paper money only works if people trust the system behind it. And that trust didn't come from a merchant could deposit money in one city and receive a paper note that could be redeemed hundreds of miles away. No gold caravans, no armed guards, just trust backed by institutions. Sound familiar? It should, because this is essentially an early version of banking transfers. And these systems didn't stay inside China, they spread outward. By the time of the Tang and Song dynasties, the Silk Roads had evolved into something unprecedented. They weren't just connecting China to its neighbors, they were linking entire civilizations. Chinese traders in Central Asia, Persian financiers in Samarkand, Arab merchants in Baghdad, Indian moneylenders along the Indian Ocean routes. And each group brought something new to the system. Islamic finance meets Chinese innovation. Islamic merchants introduced sophisticated accounting, contracts, and partnership structures. They also brought letters of credit, allowing merchants to borrow money in one city and repay it in another. Combined with Chinese paper money and state-backed guarantees, the Silk Roads became a transcontinental financial web. Not one currency, not one bank, but a system that converted trust into economic power. And here's the key point. This wasn't controlled by a single empire. It was a networked system, resilient but fragile at the same time. As trade exploded, so did speculation. Merchants borrowed heavily to fund long-distance journeys. Local economies became dependent on global flows. Prices in one city began reacting to events thousands of miles away. For the first time in history, economic shocks could travel globally. A war in Central Asia could disrupt prices in China. A drought in Persia could ripple through Mediterranean markets. This is globalization, and it came with winners and losers. Large merchant families grew powerful. States taxed trade to fund armies. Smaller traders were crushed by volatility. Sound familiar again? It should, because these are the same dynamics we see in modern financial systems. But the Silk Roads were approaching a dangerous threshold. The system was growing faster than the institutions that supported it, and that imbalance would eventually matter. By the time the Silk Roads reached their peak, the system looked unstoppable. Trade stretched from East Asia to the Mediterranean. Credit moved faster than caravans. Paper money replaced metal across vast regions. States grew wealthy, taxing commerce instead of land. But systems built on trust have one fatal weakness. When trust breaks, everything breaks with it. The first major fracture came from the very innovation that made the Silk Roads powerful: paper money. Overissuance, the ancient inflation trap. During the late Song dynasty, the Chinese state faced mounting pressures: expensive wars on its northern borders, rising military costs, a shrinking tax base, growing dependence on trade revenues. Instead of raising taxes or cutting spending, the government chose the path that has tempted states throughout history. It printed paper currency, allowed the state to pay soldiers, fund infrastructure, and maintain stability without immediate backlash. But here's the problem. Paper money is only valuable as long as people believe it can be exchanged for real goods. As more currency entered circulation without matching economic output, prices began to rise. Merchants noticed. Peasants noticed. Foreign traders noticed. Trust, the invisible glue of the Silk Road, started to weaken. And once that happened, merchants began demanding payment in silver, gold, or foreign currencies instead of Chinese notes. The system was unraveling. Then came the second blow: the Mongol conquests. At first, the Mongol Empire actually revived the Silk Roads. By unifying vast territories under a single authority, the Mongols reduced border conflicts, protected trade routes, and encouraged commerce. For a brief moment, globalization surged again. But empires that expand quickly often collapse just as fast. As the Mongol state fragmented, so did its control. Roads became unsafe, local warlords imposed new taxes, contracts lost and trade insurance collapsed, merchants pulled back, credit froze. Long-distance trade, which relied entirely on predictability, began to fail. This wasn't just an economic slowdown. It was a systemic breakdown. As the Silk Road's financial system weakened, the effects spread outward. Cities that thrived on trade declined. Caravan hubs emptied. Regional economies turned inward. For China, the consequences were severe. Loss of monetary credibility. Once trust in paper money collapsed, it was almost impossible to restore. Even when later dynasties tried to reintroduce currency reforms, merchants remained skeptical. The economy reverted to metal-based systems. Transactions slowed. Liquidity dried up. What had once been a fast-moving financial network became rigid and inefficient. The end of Silk Road dominance. Maritime routes began to replace land routes. European powers, watching from the edges of the old system, learned crucial lessons. Control the money, not just the roads. Build financial institutions independent of political instability. Use private banks alongside state power. The center of global finance slowly shifted west. Not because Europe was more advanced, but because the Silk Roads had shown what worked and what didn't. Chinese rulers didn't ignore the crisis. They tried to fix it. But their solutions often made things worse. Fix number 1: more regulation. States imposed price controls. They restricted private trade. They punished merchants for hoarding metal. This backfired. Trade moved underground. Black markets flourished. State revenue declined further. Fix number 2: forced currency acceptance. Governments demanded that taxes be paid in paper money. But forced trust isn't trust. Merchants simply raised prices to compensate, accelerating inflation. Fix number 3: isolation. Eventually, China turned inward. Foreign trade was limited. Global integration was reduced. The Silk Roads faded into history. These fixes share a common flaw. They treated symptoms, not causes. The real problem wasn't trade. It was institutional fragility in a globalized system. Now here's where this story stops being ancient history. Because the same patterns are playing out today. Global finance without borders. Modern financial systems move trillions of dollars instantly. Like the Silk Roads, today's system relies on trust, credit, interconnected markets. confidence in institutions, and just like the Silk Roads, it's growing faster than the structures that support it. Debt as the new flying money. Governments issue debt instead of printing paper notes, but the principle is the same. Promises of future value sustain present spending. Global debt now exceeds 3 times global GDP. That's not a statistic, it's a warning sign. Systemic risk travels faster than ever. A financial shock in one country ripples worldwide within hours. Supply chains collapse. Currencies fluctuate. Confidence evaporates. Just like the Silk Roads, only faster. The Silk Roads didn't fail because globalization is bad. They failed because financial complexity outpaced institutional trust. And history shows us something unsettling. Every global financial system believes it has solved the problems of the last one, until it hasn't. 1. Global finance is built on trust, not technology. Roads, ships, computers, none of them matter without credibility. Once trust erodes, systems collapse regardless of innovation. 2. Credit can expand faster than reality. Paper money then. Debt and digital money now. When promises outgrow production, instability follows. 3. Financial power shifts when systems break. The Silk Roads didn't disappear overnight. They faded, and power moved elsewhere. That process may already be underway again. The Silk Roads remind us that globalization is not permanent. It's a phase, a fragile one. And the question we should be asking isn't, will the current system last forever? It's, what replaces it when trust finally breaks? If this story changed how you see money, trade, or globalization, take a moment to like this video so more people see it. Subscribe for deep dives into economic history that actually explain